is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Hi, this is Llanes with WealthNet Investments. Today I want to talk a little bit about some situations that I'm seeing very often, some of the problems and implications of the situation, and how we deal with that, how we deal with really growing capital. And let me just kind of start from the very beginning. And I have my notes here because I'm really going to be referring to a lot of numbers. So hopefully that doesn't distract you from me looking down. I want you to understand here today that one of the biggest problems that we see, and I'm sure you may have this problem yourself, we see a lot of people who need to accumulate money. They need to grow their money aggressively so that they can have future savings to basically fund their lifestyle. But there's a lot of problems that they've been experiencing that's keeping them from meeting their goals. And one of the biggest problems, of course, is that we have this erosion of capital that comes from taxation and inflation. Most people, if you take the average retiree during their retirement years, they're going to see their expenses go down by about a half. Their purchasing power go down by about a half, meaning that their expenses are going to double during their retirement. That's a big problem. So capital has to keep up with that. And then the other thing is taxation. Taxation becomes a bigger problem over time. A lot of people think, well, when I retire, I'm going to have less income, so my tax bracket's going to be lower, so I'm going to pay less in taxes. What we actually see with real life experience is that many people wind up being in higher tax brackets. They wind up getting taxed under their Social Security. They wind up having a lot of money in retirement accounts that are fully taxable when they take the money out. And their Social Security, again, is taxable many times. And they have a lot less flexibility with their deductions when they retire. So in reality, we don't see that as being as big of a benefit as people want. And unfortunately, a lot of people try to last minute say, hey, can I convert to a Roth or something like that to try to ease the pain? But now it's a little late because it costs a lot of money with taxes to do that. So one of the things that I want to talk about now is how we can kind of overcome those. And one of the strategies that we have developed that I find to be extremely attractive for my own personal money, as well as for other people. And I want you to know about it. And I'm going to kind of just walk through it. But as I'm walking through it, I want to talk a little bit more about, some of the reasons why people are not actually achieving this growth objective, and what are the ways that our strategies overcome that. And now let's just talk a little bit about what we're seeing in the marketplace in terms of with the news. There's a lot of conflicting advice out there. You turn on CNBC, you see there's a lot of different talking heads, and many of those people are extremely smart. They know what they're talking about, but they may not have the same objective as you as an individual investor. They may be talking about some institutional situation that they're experiencing, and they have a mandate for just investing in small caps, for example. And that doesn't really help you as an investor. So you wind up getting a lot of conflicting advice. You may have a whole different setup. And I think that that's really causing a lot of people to have really lack of clarity. Another thing that's causing people to have lack of clarity is there's so many different advisors that are saying different things. They're saying you should index or, buy only low cost, or they're saying you should, have this approach or that approach. And that really is not aligned with your situation too. You can't make a broad blanket recommendation based on some kind of a news media or some kind of an advisor, that have different conflicts. That's the other big part about many of these advisors. Many advisors have conflicts that are embedded in their whole compensation structure. Maybe it has to do with they have more incentives to recommend one product or another. Maybe it's a proprietary product, or maybe there's some other compensation that's higher than another. And it may just be lack of knowledge. So there's a wide variety and dispersion between what kind of quality of advice that's out there. Okay, so that causes a lot of, I guess, what I would consider to be not necessarily fear, but lack of clarity. There is an element of fear, however, out there too. There are a lot of people that are simply afraid that the market's going to correct and that there's a lot of volatility and that somehow they're going to get caught in that. Maybe they've been caught in one before, and they're just, kind of frozen by that. I hate to use the word frozen, but it almost seems like that there's an indecision there. So I think having a disciplined strategy can help you with that indecision. Investors, a lot of times, they're just waiting for the market to gain before they actually take advantage of the market. So a lot of people don't feel comfortable investing until after the market has had a big gain. And at that point, then they get confident and then they invest. And then sometimes that could be at the wrong time. And then when they do invest, they tend to invest without some form of solid risk management approach. And that leads to more perpetual problems. So the ability to be comfortable based on something that's happened in the past may not be a good idea. In fact, there's studies that show that investors tend to choose the highest correlated investments with the least amount of diversification based on past performance when they make their decisions, when they do it on their own. Not necessarily good. So I think another big problem that we're seeing is that a lot of people just don't have time. They have a good profession, they're making good income, and they just don't have a whole lot of time or expertise to invest. So they wind up doing what everybody else is doing. They're going to buy the passive exchange traded fund, or they're going to buy mutual funds. The problem with that is a lot of these investments are really, there's a lot of hidden risks in those, some of them being unnecessary capital gains tax for the mutual funds, basically high expenses as well in the mutual funds. And in the exchange traded funds, because they're passive, you have this bias towards large cap in the portfolio, which is not necessarily a good idea, especially when markets get volatile. So I think that is something that's leading to suboptimal results. And the implications to this are pretty clear. Because investors have lack of clarity and because they're getting conflicting advice, there's fear of market corrections, that leads to inaction, or it leads into missed opportunities. So let's start with the first one, the inaction. The inaction is pretty basic. If there's inaction, maybe the money is sitting in money market, and of course interest rates are low, and that doesn't lead to solving that first problem of beating taxes, beating inflation over time, and having that money available. Secondly, if we're dealing with the other one, which has to do with missed opportunities, they could have had money that were earning a higher rate of return, and by the time people jump in, it may not be the best thing. So if you're not participating in the market in a way that you can tolerate, you're going to have inferior rates of return. So your capital growth is not meaningful and your cash returns are going to be low, etc. So this leads to inconsistent returns, chasing the market at the wrong time, losing money. And another big one is lack of diversification and poor performance. And a lot of this has to do with the fact that many investors are not prepared for market changes. They don't have a strategy for market changes, which leads to large losses or miss out of returns. And passive investments, again, there's a risk management problem with passive investments. The S&P 500 can have huge drawdowns. So a lot of people just say, hey, I'm just going to invest in the S&P 500. And over the past 10 years, that has been an exceptionally good trade. And when I say exceptional, I mean historically exceptionally good trade. So the problem is when everybody gets lulled into this feeling of safety, it's really the wrong thing to do. And history does show that over and over and over again. So it's not a great long-term strategy. And of course, the mutual funds with their high fees, expenses, phantom taxes, we need to have a strategy that's really more geared for the long run, that takes these things into consideration, because most people want that aggressive growth, but they also want to be able to have some proactive investment strategy that's going to allow them to reduce risk when the markets are drawing down, when they're moving to a high, then they're starting to head down lower. It does make sense to reduce risk. So I'm going to talk a little bit about a disciplined approach. So we have a strategy, and this strategy is based on history and numbers. And I want to talk a lot about numbers right now because I trust numbers more than I trust opinions. When you get on the CNBC and you look at, I hate to crush on CNBC, but any of the news media guys, you're going to see a lot of opinions. And these opinions, they may be true, they may not be true. But the facts is if you watch the price and if you watch the investments themselves and you objectively look, that is your best indication of what to do. So using a disciplined approach to select stocks based on the facts, the numbers, that will give you a higher propensity to perform well. That is the first thing. And the three main categories that we think are the best to look at would be quality, which would be how stable the company is, the valuation, what you're paying for it, and very, very importantly, the technicals. What is the supply and demand for the stock itself? So when we're looking at these factors, we want to have them in a basket. We want to have the clarity to know which one of these investments that we're going to even consider based on those factors. So we're gaining clarity by doing that, whittling the market down. Now, what's also more important is that since we're trusting the data rather than the opinions, we want to find stocks that are verifiably trending higher, because no stock can go from 50 to 500 unless it's hitting highs, unless it's trending higher and it's displaying price improvement. So we want to actually physically see that in our trades. Now, when we do this, we also want to manage risk, right? Because when we have a big market decline, if the market draws down 10% or more, a lot of times the best thing to do is two different things. The first thing would be to make sure that you give the stock less room to go further down than it already has once markets start showing that they're moving down. And then the second thing that you want to do is just not take any new purchases. You don't want to be buying a lot of new stocks when the markets are drawing down, when the trends are rolling over. You just simply don't want to do that. And you can objectively measure trend. You could objectively measure drawdown. And using that discipline helps us to really just stay in tune with what's happening in the market. It's really, really important that when you invest in stocks that you have a predefined risk point. So if you're looking at that stock, there's a predefined point where you say, that is my exit point if this stock does not move in my favor. That allows us to do predefined risk calculations and to manage how much we're going to risk in each opportunity and size our positions appropriately so that we stay in our risk profile, but we still stay wide open to the upside. So that's the other key element of a winning strategy in equities, is that you want to have a strategy where you can allow the big winners just to run. Because one of the beautiful things about stocks is, and if you go back and look at some tests, and I'm going to actually go over some numbers here to kind of illustrate this, you see particular stocks and that just really take off, and they can triple, quadruple, 10 baggers. And we want to hold on to those. You want to give them a lot of room, and you want to hold on to those big ones. So letting your riders win, or riding your winners and cutting your losses, that sounds so trite, but that is the key to getting what's called an asymmetric return. And I'm going to talk more in a few minutes here about what the asymmetry looks like. But we want to manage the risk when the market's not doing well, and we want to raise cash, go into safer investments when that happens. So let's say the market starts drawing down, and we're fully invested. Some of our stocks are going to get stopped out. They're going to come down to their trailing stops. Some of those stocks we're not going to be taking new buys during that period of time. So they may all get out or partially get out. And then when the market starts resuming, we'll have more opportunities that you'll start seeing more companies start trending higher. You'll add more to it. Another key element to this is selecting from a universe, like I said, that have the propensity to do better than the overall stock market. Some of those stocks have certain characteristics, like they may have new products and new services that are in high demand. They may be in a situation where they're literally finding an industry. They're redefining this industry in such a way that their product there's really not a whole lot of competitors. Another thing that can happen is you could just have a big change in that industry that's occurring, a change in management, a change in the product mix. There's a variety of different things, but what is always going to happen is you're going to see the price start improving when everything starts getting better for any company. So that's why it's so important to have this ability to look at the trends and to have a very disciplined quantitative approach to being in the market. So I'm going to talk a little bit about just the concept of going into a trend. So I'm just going to chart a couple of stocks that you may have heard of, and just to kind of illustrate the concept. This here is a chart of MasterCard. MasterCard has been one of our best performers. It has just been on a roll for a long time. And what you see, this is a price chart here, and this blue line here, that is a breakout indicator that we have. It basically, we're looking at levels that the market has been at a higher level, and we're looking at the averages of those higher levels, and we're looking to see that the stock is actually breaking through those levels and moving into higher ground. And as you can see, going back in time, back in 2017, it continually moved up, 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 up. And below this, what we have is a level where we would lock in a profit, right, or take a loss. So we know that the difference between those two is how much risk we're taking in any particular stock. Well, I'm using this example as a prime example of a stock that just does not pull back a whole lot and you just don't get out of. This particular stock has been on a roll and it has not pulled back to any kind of a stop to where we would get out of it. So it has made a tremendous gain. This is an example of holding on to a winner. Not every stock is going to be like this. In fact, the minority of stocks are going to be like this, but they make so much money that they outweigh any losses that you have. Now, I'm going to use an example of another stock that everybody knows, that everybody thinks about as being a great company. This is Apple. Now, you can see Apple was, if you go back early in 2017, was trending higher, stair-stepping up, never getting stopped out, getting close, but never getting stopped out. And then over time, what happens is the company goes and it gets stopped out and you're out of the stock. And it goes into a very wide, erratic type of a pattern before you can get back into the stock. Now, this is the thing about this type of trading. When you have a trending period, you make tremendous profits in these. Whenever you have a choppy period, when things are moving sideways, up and down, you don't make money with this type of a strategy, with this type of pattern. So what you want to do is you want to diversify the types of companies that you have so that you're always having something in your portfolio that is more probable to trend. So it's really key to have diversification rather than just, buying all, Microsoft and Facebook and Apple and then just saying that's going to be my portfolio. That's a recipe for disaster from a risk management perspective. So there's also a lot of companies that you may not have heard of. One of the ones that we invested in that you may have seen is a company called IQVIA. And IQVIA is a company in the medical field, and it's just been on a roll. Not everybody has heard about this, but it has the quality and the valuation when we start buying it. The technicals kicked into play, has not really stopped out, and it's just really stair-stepping higher. So this is the concept. You have companies that are smaller, for example, that, for example, recently we're seeing some companies like TGD. Let me get this up for you here. So this particular company, again, many people have not heard of it, but it's trending very, very well. So you're gonna get signals, and you're gonna get companies that you may not have heard of. A lot of them have, again, new products, new services in high demand. So I want to talk a little bit about the statistics of this type of trading, this type of portfolio, and we invest these for clients in separate accounts. So you can own these stocks directly. Again, we don't want to have a middleman here. We want to own these stocks directly. But if you look at the trading pattern going back to January of 2000, so we've got that just before the dot-com bubble in the data. So we're going from January 2000 all the way up through August, If we look at this type of trading, look at all the stocks in the Russell 1000. So that's a pretty large universe of companies. And you go back and you just back test or simulate this type of strategy. What you see is an average profitable trade. The average trade is $6,224 made for every $10,000 you invest. It's amazing. It sounds like, wow, I invest $10,000 in a stock. So every single trade we put $10,000 in, okay, just to give you some context. And the average win was $6,506, right? And the average loss was $1,953. So this is very interesting. You notice that the average win is much larger than the average loss. That is what we want to see. We want to see asymmetry between the average win and the average loss. What's interesting, a lot of people think, well, you need to be really accurate to make money in these types of strategies. And the answer to that is no, you don't. You need to be relatively accurate. The accuracy of this type of trading is only 49%. So what that means is for every 10 stocks that are invested in, only 5 of them are profitable. It could be less, and that ranges, over time. It could range between 30 and 60%, really. But the narrower expectation is between 40 and 50%, closer to the 40% side. But because you have asymmetry, that when you do make money, your winners tend to make much more than your losers. And a lot of that has to do with the fact is that we're managing the risk, right? If a stock starts moving against us, we pull out of that stock, and we have very clear predefined risk management rules on this. So we give the stocks quite a bit of room, though. It's not like you're not giving a room at all. In fact, the average loser is held for 189 trading days, which is roughly 6 months-ish. So, it's not like you're buying a stock and immediately stopping out. You're really giving these stocks room to breathe. Now, that is another key element of this. Longer to intermediate term approach works the best for equities. You really want to find stocks and give them room to breathe. You want to find good quality stocks that have some good things going on with them and follow those trends as long as they're in your favor. So the statistics show the asymmetry. It also shows your average win greater than your average loss. The accuracy is not necessarily that huge, but because you have the asymmetry, this allows you to make money in the market over time. Now, does it make money every year? No. But you have a disciplined approach, and you can scale it in a way where it makes sense. So for investors that want to aggressively grow their money, but be more active, don't want to just succumb to the indexes or buy a mutual fund. You want to own these companies directly, and you want to be able to pull back when the markets are telling you we need to be pulling back, or get more aggressive when the market is telling you these stocks are trending, and really go to the stocks that are demonstrating that they're outperforming the market and they're trending higher. This strategy could be something you can add to your portfolio. So if you want to learn more about this, just give us a call. You can go to our website, wealthnetinvest.com, hit request a meeting, and we can just have a call. Either me or one of my associates can talk to you. But I highly recommend those of you who are really tired of just throwing in the towel and buying these ETFs, or just buying these mutual funds, and really take more control, at least allocate part of your money into this type of strategy. I think it makes a lot of sense. It increases the diversification of your strategy pretty dramatically. So anyway, that's what I wanted to talk with you today. Today is actually Labor Day. I'm actually working on Labor Day, but to me, this is not work. So I hope you find this interesting. If you have any more questions, just feel free to go to our website and contact us. Also, follow us on Twitter. You can follow me. I make comments throughout the week about various things that we're seeing. And other than that, happy investing and happy trading. Louis Llanes with WealthNet signing off. So I want to talk a little bit about some of the disclosures that we need to discuss with you, because in this presentation, I discussed hypothetical performance and a back test. And it's really important that you understand that there are limitations with a back test. Also, keep in mind, WealthNet Investments, the firm that I own, is a registered investment advisor. So we have a fiduciary obligation to always talk to you straightforward and to let you know about the rewards and risks of any investment strategy. So there's a risk of loss, of course, with any investment strategy that can be substantial, especially in equities or in any other type of asset that moves around like equities. So you really need to consider anything that you do investment-wise based on your own personal situation. So there's no assurance that WealthNet Investments can provide a profit or that we can avoid substantial losses. So that's one thing. Now, and I want to talk a little bit about the backtest and hypotheticals. It's very important to understand that hypotheticals can be useful in developing strategies, but there are limitations. And I want to just go through a few of those limitations with you. The results that I talked about with the trading strategy, they do not represent actual trading of an account. It represents a trading strategy that has been backtested on data. Now that data, of course, you have hindsight biases. We know what happened in the past. So there's always a bias to that. There are things that we do to try to limit that, but there's always some bias that's there. So we need to keep that in mind. It doesn't necessarily indicate the skill of any advisor on a backtest. It just gives you a statistical representation of what that strategy would have done over a time period. It's important to understand also that if there was any material differences in the economics of the markets during a particular time frame, that your results could be different. Now, we used a long time frame with a lot of different bulls and bear markets to try to limit that, but there is always some situation where you can have a different economic scenario that would change the outlook of any backtest. Now, to remember this, the numbers that I was talking about were not actual account numbers. They were just a strategy that was backtested over data. Now, a backtest for this strategy, a client may or may not follow the exact way that this is being done. It depends on the client's situation and how we're managing that particular account. So there could be differences between the backtested result and an actual client result based on any kind of customizations that are done for that client, any kind of slippage or commissions that are involved. Now, we do take account for slippage and commissions, but we want to know, it's important to understand that not everybody is going to invest in that particular way. So anyway, just a few little disclosures I wanted to share with you so that we're really clear about the reward and risk of any backtest. All right, thank you very much.
The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals. If you like this information, be sure to subscribe and follow us on Twitter and Facebook.